this 3780 level, okay? And we're trying to hold it. We're under the 50. Maybe we hold it. I still think we're going to take it out, the 780 level. Of course, we could have some type of vicious rally like we had Monday. Um, but this is the next support level right here. Okay. Everyone see it? So there's your daily Forex gal. So you see we're under the 50. If it stays under the 50 for a day or so, it only makes sense that maybe we're going to go for the 200 day here. All right. So, Canada with a stronger dollar, it's acting okay, but it's definitely not a superstar. I thought this was a flag. It still could be one. But, I can't rule out another pushback down to 61.8. I bought it at 50% at 604 and had some money made. Always take partials, still have some money made, but I'll keep a piece on. Yen just keeps smoking. But interesting here on the 10-year, we're making a lower high so far. We could make a higher high that would really panic the market. What kind of high do we have here on this time frame? Hi, Monica. What do you call it? When price does this and momentum does that, what kind of high is it? This is a lower high. Yeah, you have to, there you go. So some of the guys have been, paying attention to, and you could get that too, see that it's a confirmed high. Okay. So sometimes, usually markets don't top long term on confirmed highs. So we could still do like A, B, C, and then go again, or we could blow here. Basically, this is saying I don't think that we're going to have that this is going to be the final high. So that's a look there. So you would think if that happened, that maybe we get some type of pullback in the yen. Dixie, here we are. We still haven't taken out yesterday's highs. We could have a C down here. And maybe that would be supportive of the S&Ps for a while. And the crude was tough. I got stopped out a couple times here in crude. I thought we were going to, stop at 61. And, it just seems like there's too many missiles flying around. But, you could be short against 62 now. I think this is about 61.8 back. And then something else I was talking about that happened. What did I say was going to happen in the gold? Who remembers? Because you guys were asking me about it for a few days, and I went over it yesterday. Anyone remember? Yeah, but for what, Kevin? And we did go down to form this. So this is why I thought we'd have a third drive, one more low because it was incomplete here. And sometimes you could have a 3 fractal on the third. But anyway, that's a pretty classic look right there. Didn't quite get down to that 1686 level. There's my wedge line. It's down here. Yeah, is this the wedge you're looking at, TJ? Where the line comes in down there. 1687 was some type of fib. I've had it here on my charts for a while. But it doesn't have to get down there, right? Doesn't have to. And let's see, what else do I want to talk about here? I think Euro's going to have on any rally, if we get a rally in the dollar, trouble at 21.35. We could get 100 pip pop. Otherwise, we're just rolling over. This was a pretty weak rally. And when something's bad, because, all right, Blake's been talking about Aussie for a while since we had that big down day, key reversal up here. So everyone wants to sell it up here, right? And it still is possible that we have this, and then we have one more pop up here to 78.70, even 79. But the most bearish thing a market could do is not accommodate the people that want to sell it up here. You know, they're all waiting. Well, it was 80 just last week. How can I sell it under 78? Right? You understand that psychology? You know why I do? Because I think the same things. You know, I don't want to sell it down here. You know, I'll sell a nice rally back to, you know, maybe 79. But, you know, sometimes the markets, when a real move's underway, doesn't make it convenient for you to get such a great price. Anyway, we'll see. So just talking about what happens in our heads, and, you know, trading mainly is, you could be a great technician, but if your psychology is screwed up, it won't matter. So keep an eye on your thought life and what you're saying. I coach myself. I remember Sunday night talking to some of my mentees and saying, you know what? Be patient, Dale. Be patient. And told them I'm coaching myself. So your self-talk is very important in this business. So let's hear from someone other than myself right now. We do have a great interview. David Keller, CMT. David's very, you know, clean, objective, stock guy, ETF guy. So stick around for that. And with that being said, I'm going to bring Blake in. And Blake, do you agree that sometimes, you know, when a big move is underway and people, you know, say they don't want to chase it and they're going to wait for, you know, a move that gets them a better price, that on big moves, the market doesn't offer that opportunity sometimes.
Yeah. A lot of times that you just
Yeah.
start going, and then
Yeah.
you're just on the run, right?
Yeah.
Yeah, and then it happens. That's not happening today. Today was actually one of those first days that I've gotten up this, like, the last couple of weeks. I was just telling the guys and gals in the Forex Analytics, you know, the chat room for our subscribers. I was just saying, man, this is like the first day that it feels like nothing's happened in European trade, where things just kind of slow down. It seems like for the last couple weeks, and maybe this is because Steve was out for a few days. I feel like I was getting up and it was like I didn't even have time to breathe. The markets seemed like they were so busy, but like I said, maybe it was because Steve was out for a few days.
Maybe it's because there's mucho data today, and I think some Fed speak that the Europeans held back.
Yeah, and that is also really key, and I'm glad you brought that up. Today we do have, which I think is going to be pretty important. What I think what everybody's waiting for is actually, you know, Powell. He's speaking, and it's hosted by the Wall Street Journal. So you know the questions are going to be good, right? It's not like the um, the U.S. automotive business leaders, conference. You know what I mean?
Yeah.
This is going to be something that might actually move the needle a little bit. So I think you're exactly right. I think the market is actually just it's waiting on that. So what we have to do is just kind of be patient, because you're right. I think Europe has really held back. I noticed you had the Aussie up
Yeah.
on your screen.
Yes. I did.
Earlier, and
Yeah.
the Aussie, I'm actually monitoring really carefully today, and and going into today and going into the next couple of days, actually, because the Aussie, and if you guys didn't read the chart of the day yesterday, it was the Kiwi. Let me just show you really quick right here. That we're sitting on a 5-month trend line, with the Kiwi. And, if you were in the chat room overnight, I told, everybody in the chat room, I'm going to sell some Kiwi, some New Zealand dollar at 72.70. I got filled at 68 overnight, and I already closed it. I closed it this morning. As soon as I got up, I got hit right around here, and then I closed it out this morning. But I'm still keeping an eye on it, because I think a break below 72 is going to be quite bearish. So, and if you guys don't know, let me see if I can. This is the Forex Analytics chat room, just so you guys can see it. And this has been a slow day. This is where uh
Where traders go to become better.
well, I don't. Yes, that's the hope, right? The hope is you come here to become a better trader. But what it really entails, and this is where I got up right here. Good morning, everyone. I got triggered short Kiwi overnight at the 72.68 level. Now, if you were, this is I'm gonna take you to the night before. So and this is like less than 12 hours ago. I just got to go. These are all the Europeans and Asians chit-chatting around. And it's still going. Hold on. Just give me a second here. They're still going. My gosh, it's like 2-3 o'clock in the morning. Okay, so here I am. All right, so yesterday,
Even Congress is taking the day off, Blake.
yeah, here we go. This is yesterday at 3:25, so that was whatever, that was about 16 hours ago. I said, hey, I'm going to short a move to 72.70 in Asia, and that's
You flew all the way to Asia?
all the way to Asia. That's but that's the kind of chatting that goes on in our chat rooms, and it's there's a lot going on in there. But you said it's where traders go to get better. You hope that people get better. I can't guarantee that. But I'll tell you one thing, it's a great place to grab ideas from people.
Well, let
Right?
me ask you this. How many traders in there, Blake, do you believe make their livings from trading?
We've asked that question before. There's a lot, but I think a lot of traders are dual purpose. They trade.
Yeah.
They work other jobs. They and
Yeah.
they come in when they can. And there are some that trade full time.
Yep.
That's not uncommon, because it's a place where everybody can share ideas, but also keep good company too. Because I'll tell you, it's one of the loneliest jobs in the world is trading. It really is, and without a community, I don't know how you do it. I honestly don't know how you do it. And I've been a very big advocate since day one of my trading career. When I started trading in November of 1996 is when I first sat down at a trade desk. I was always on a trade floor, or I was in with a community, being able to share ideas with other people. There was a period of 6 months where when I was in Dallas, probably 2000 or so, where I think we were so fed up with the market, because it was the exact same market that we're in right now. And I want to share this with you guys, because I think this is actually pretty good information. This was, if you go back to 1990, I'm sorry, 1990, 2000. I got to find there enough information. 1999, 2000, right around here. Okay. You can see June, August, right around here. I was so fed up with the market, and so were the rest of us, of it going straight up all the time. Does this sound familiar? It was going straight up almost every day and like the pullbacks were very small. You can see how small they were. It was very frustrating. I would actually could argue that this chart right here from 97 to 2000 was very similar to probably this price action, sell off in 98, 99, and then just grind higher, right? This is kind of like the COVID sell off and then grind higher. right? So it was so frustrating at that point that myself and other traders in our office, we actually started trading from home. And that was very early in, I mean, connection sucked. And I remember trading from home for like, I don't know, a few months, maybe like 2 or 3 months.
Was
And we
that
had like,
dial up
no,
AOL?
it was we had I think that was the very early, what was after dial up? DSL, is that what it
Yeah,
was?
yeah, that's right.
It was that right?
Over the
DSL.
phone lines, yeah.
It was, yeah, it was like our first high speed internet was right around then. And I traded for a couple of months there. And I remember how boring it was and how much I hated it.
You know, a lot of traders don't know, Blake, but squawk boxes originally were not made for the retail trader. It was a way to have community within the brokerage firm of analysts and masterminding with people and asking questions. So, you know, Squawk Box was made as, kind of the center of gravity every morning about ideas that you would consider executing every day from the analysts at the company.
Well, that's good to know. That's really good to know. Anyway,
Yeah.
thanks for passing along that knowledge. But I guess the point I'm trying to make here is we do have a good community in Forex analytics, and it does make a difference, especially if you, like I said, I've always been around a community and traders, and it minus that one period in my life for a few months where I didn't, and it was really hard because you don't have other people to bounce ideas off of, and right now we do. And speaking of ideas, I'm going to leave you with this, and then I'm going to bring in Stelios and Steve. Is that yields have stopped rallying right now, but the dollar Swiss and the dollar yen have not. So the dollar yen and the dollar Swiss continue to squeeze higher. There's the dollar Swiss. Here's the dollar yen up at its highest levels right now. And if you look at yields have stopped, but that doesn't mean they're going to. I think this might be a way that the market is, well, I guess yields have popped up in the last hour. This might be the way, a way of the market thinking, maybe the Fed chairman isn't going to say anything about yields today. And that's the risk, because if he just kind of says it's not really a big deal, we're going to let, basically, yields are going to rise and it's fine. It's showing a stronger economy, blah, 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 blah. Maybe the dollar yen and the dollar Swiss continue to rally as a result. So anyway, we got, let's see if Steve and Stelios have some comments coming in. How you guys doing this morning?
Hello, good morning.
Morning.
We're all good, I think. Powell, it's a very interesting thing because you said he might mention yields and say, "Oh, it's no big deal" or anything. But on the other hand, there is a chance always that he might not discuss, but he might mention yield curve control or anything like that. So I think we have the risk of going both ways with Powell now. So I think it's going to be.
You really think we're at that level right now where the market is even thinking that
he's going to talk about yield curve control?
That he could, yeah.
No, I think the possibility is very low. That's why I think it's a risk that if he does, then there's going to be.
I see, because you don't think it's really that it's really priced in at this point.
Yes.
If he does, for some reason, he gets asked the question and he mentions it, you see it, you end up seeing a big reaction because no one's expecting it. I get it.
Yes, there is a risk of that. I don't think he will, because like you said, I don't think we're there. And, the most likely scenario is he says nothing. And, he just remains dovish, the usual thing. And he gives us nothing new. But it's a possibility. That's what worries me a little bit.
Call me stupid, but can someone explain what yield curve control is?
What do you mean? So basically, they want to control all parts of the curve. They control the front end by Fed funds rate. They're buying 10-year treasuries, and then they're going to be buying 30-year or whatever else.
Okay, and what is exactly different from what they've been doing so far? I mean, my basic question is not what it is why is it different? I mean, Long-term yields, we've seen them do twist in the past, right? Short-term yields, they haven't stopped, short-term bonds, they haven't stopped buying them in 13 years. So basically, my main question is, why is this something new or revolutionary? They've been manipulating the yield curve for 13 consecutive years. So what exactly is the difference?
They're going to take a little bit more, and that's going to hurt the banks. That's a problem.
The banks are all bankrupt anyhow. It doesn't
Yeah,
really
but
matter.
a totally flat yield curve is the nail in the coffin for banks.
No, it isn't, because they will keep bailing them out until the sun, goes dark. I mean, that's not the issue. I mean, the banking model of making money has died long time ago, and it's not going to be revived until or unless we go back to normal economy.
So you think that even if they announce, if the Fed, and the Fed's not going to, and Powell's not going to even, this is not even a discussion point anyway, right at this moment in time. But what you're saying though, Steve, is that even with talk of yield curve control, it's going to do nothing to the market. So the market's
No,
like,
I think the
market's
market
worried about nothing right now.
I think the market is going to rally even further if we're talking about risk assets, but for one reason only. In essence, the only difference with announcing yield curve control is an indirect way of saying we're going to increase quantitative easing. I think that's the only reason why it's going to have an effect in the market, not because they will actually end up
But
doing
that
anything
is the
different.
reason. That's
Exactly.
that's all the market cares about.
Exactly. But my point is, it's just the increase of quantitative easing that matters. Yield curve control is another way
It's just that they're tools. They're just
to
tools.
reformat what they've been doing in 13 years in words. I mean, I remind you that a few months ago they didn't even want to validate that what way they were doing was quantitative easing.
Well,
yeah. Steve,
okay. Well, Steve,
you have, yeah.
Here's the thing. I'm gonna pass you over to the charts, and then you can spend the next 5 minutes pointing out to traders what you're looking for and what you're looking at in the next, maybe 12 hours. And then I'm gonna come back and do the morning edge in about an hour from now. So
Absolutely.
Perfect.
all right. Good luck, guys.
Dale,
thank you.
bye, mate. Dale, do we have an interview today, by the way?
Yeah, I think
Okay.
we do.
I think we do as
I was
well.
just going to say
The answer to that question is yes, we do. And his name's David Keller. He's
David Keller,
he's a
yeah.
CMT, and he's coming up in about 6 minutes.
Perfect. Okay.
Perfect. By the way, Steve, whenever the Fed did QE1, QE2, Operation Twist, all that, the market responds. So I think
Of course,
you're right.
of course.
I think you're right in what you're saying as a principle, but the market will respond to
Of course it will.
things that he's going to say. But yeah,
because the only thing the market is going to hear is, oh, more quantitative easing. That's all that matters.
Yeah. And that's that's what I was referring to. But anyway, so that's one thing. We have the OPEC meeting, which has started apparently today, or is starting, and there's an issue about increasing supply in April, which is not set in stone yet. So they're discussing it. And from what I read, I'm not an oil expert, but from what I read, the Saudis are a little bit skeptical as to how much to increase supply, if they want to increase supply. And you have other countries like Russia who want to go full blast ahead. And we had ADP yesterday. We have payrolls, non-farm payrolls tomorrow.
Mm-hmm.
We have jobless claims in about 4 minutes, but really, unless there's a huge outlier number, they're not going to matter.
True.
And still
750 is the expectations, by the
Yes.
way, for jobless claims.
And still in the markets, I don't see anything changed yet. The S&P tried to break below 3,800, which we've been saying is the previous lows. It bounced right back up. So at the moment, nothing has changed, but we're close. The yields are close to 150, 10-year, I mean. So, and nothing has happened yet, unfortunately. But, the market's getting maybe a little bit itchy.
Perhaps a catalyst could be, Powell disappointing with not,
Yeah.
adding more fuel to the, monetary easing fire. Perhaps the market is somewhat expecting, at least vocally, to, promise more more intervention if needed. And if he doesn't do that, perhaps then the market, reverses lower, because so far it has pared back its losses, as you said. On the day it was lower overnight. Seems that it's going to be opening more or less flat. The DAX is also holding up, quite nicely, having to do with the FX markets. They haven't been really doing much. I still believe that the dollar and risk assets look like they can make a move. What is what is more promising here is USD yen, which has also now broken above this channel. So it seems that USD yen is opening more upside targets. As we said yesterday, 108 is the next target to the upside. Clearly, as long as we trade above these resistances, roughly, let's say above 106, I think that that should favor yen pairs. If you want to be long against dollar or the yen, obviously you should choose to be long against the yen, because the yen seems to be weakening, and it seems to be on the move now. There is a little bit of a divergence. The USD yen has posted a higher high, while for example, 10-year yields have not. But this might be a short-term thing. I mean, it's not enough to really determine what's happening here. So far, the rest of the markets have not really done anything great. Crude recovered yesterday, and it seems to be recovering today as well, still holding the channel. Metals, not doing much. But we'll go into detail in the second part of the show. Dale is your guest here.
Yeah. Yes, sir.
Okay, good. So let's get him on then.
You sure you don't want it? It's a minute early. We
Is
usually
it?
start a couple minutes after. It's okay,
Yeah.
I'm kidding. All right.
Okay.
Just give me a hard time. All right, David, I'm going to get you set up. Welcome back to Face, David.
Good to be with you, Dale. How are you?
Good. Oh, look at that pensive look as you look up
Hello.
at the tape. There's Steve. Steve is saying hello to you, David. Welcome back to Face.
Dale,
Good-
just
good.
a fast interruption. We're getting data just to
Okay.
productivity, minus 4.2 versus minus 4.7. US labor costs revised lower to 6 versus 6.6. And for some reason, we don't have the jobless claims and the continued jobless claims out, although they were supposed to come out along with the rest of the data. They seem to be a little bit delayed.
Okay. Thanks for that update, Steve. So, David, you want to share your screen, my
You
trading
got it.
warrior brother?
We just got it 745 versus 750. So, yeah, as expected.
As
Okay.
expected. Yep.
All right. So, David, I think the market's in a little different shape than the last time we talked. There was a break and then one more push to new highs up around that 3960 level, and NASDAQ really, led all the way up, and it seems to be leading on the way down, kind of reverting to the mean on its outperformance to the general market. So what are you thinking in here, David? We're underneath the 50-day, just barely holding on to this 38 support. I'm looking for 3,000 by the late summer, fall. I know that's an aggressive target, but wondering what you're thinking here, if the top is in or you need more confirmation.
It's a great take, Dale. And I would say for every stock like Facebook and Amazon that breaks below its 200-day moving average, for every stock that is unable to hold its 50-day moving average, like the S&P may, do today and tomorrow, we'll see what happens. That's when a target like S&P 3000 seems less and less unlikely. The more breakdowns you see, the more breadth divergences you see, that's where further downside seems more possible. And the way that I think about, market direction, as most technical analysts do, is it's all about probabilities. We don't know exactly what's going to happen tomorrow or
Never.
next week or next month, but
Oh, we
we
know
do have
anything and
probability.
everything can happen. That's
That's
something we
exactly
know.
right. And it's all about the likelihood of certain things happening and betting on different scenarios. And for me, there's a non-zero and growing possibility that we have a materially lower move from here. But Ned Davis used to tell me all large losses begin as small losses. So the key is, the key is now sort of focusing on when things are breaking down, right? Things don't go to zero before they break down a lot of key support levels along the way. And that's
Yeah.
why the chart of the S&P, it's not totally broken yet. It's just
No, it
it's
isn't.
half broken.
Right.
We've broken down through the first trend line, this pink trend line on my chart, which is taking the October low to the December low. That lined up with the mid-January low. We hit it again in late January, and then we broke through it. That was the first, sort of real indication in my mind that things were starting to change a little bit. We had one more high, but it sort of tested that trend line from below,
Right.
and then we
Right.
rolled over again. Step two is the 50-day moving average, and we're there. I mean, we closed right on it on Friday. We closed right on it yesterday. And, we break that. I think you'll find a lot more people mentally go into risk off mode because this is
Okay.
showing that the market itself is not able to hold up. But for me, 3,700, that's the line in the sand. We remain above that. I think you could still make a legitimate argument that the S&P is in an uptrend. We break 3,700, and I think you're hard pressed to make that argument very well.
Okay. Well, this has been a market that has been, don't get out of stocks, just rotate. So, do you think we're entering a phase if say, for example, we break down, where are people going to go? Because, they know they have to, and they're, it's illegal to go to cash with the market, right? I mean, you get fined. You have to do 30 days in county jail and then 100 hours of community service. So, I mean, to go to cash, what do you
Yeah.
think they'll rotate into?
So here's the thing, and I get the argument, the debate is this just a rotation, and are people getting out of the high flying technology communication sort of the FANG trade, and also things like the work from home trade, stocks like Zoom and Peloton, which have taken a bit of a beating, and rotating into sort of the old school names like JP Morgan and Energy and sort of the Dow names, and that's a decent argument. I'm looking at the Dow members now. And, for an Amgen that looks pretty ugly, for an Apple that's breaking its 50-day and breaking support levels, for Salesforce, which is broken down through its 200-day and keeps going. You also have something like Chevron at new 52-week highs. You have Disney not far off a 52-week high. You have Boeing, local Seattle company here, rotating back to the upside. So there are charts that are working. And as always, I tell people to lean into things that are working and lean away from things that aren't. And I'm still finding things that are working. I'm finding charts like, American Express that are breaking out to the upside, that you wouldn't know that the market's in trouble mode if you look at this chart. So I think
go ahead, David. No, I just find it ironic that what happened the last few months before these highs, possible highs, is that the two weakest groups out there were oils, because people were scarred from seeing futures go negative. So how can you ever want to buy oil? There's EVs, and the banks because of yields. They were the two laggards for years, and now they're the ones that seem to have the best looking patterns. I mean, you bring up American Express. It's not a bank, but it's financial. Do these credit card companies also benefit from higher yields just like banks do?
I mean, everyone does to a point, and that's sort of the argument, right? When it feels like yields are really high right now. Interest rates are really high on a short-term basis. They are, right? They've come up from 0.5% to 1.5% on the 10-year. So that's a big move. But if you look at the historical trend in yields, we're still way at the lower end of any sort of long-term average. So interest rates can go a lot higher. And what happens is in the short term, it's a very positive thing. It's definitely positive for banks. It's positive pretty much anything in the financial sector, to be honest.
That's what Paul has been saying, right? It means economic growth. Do you think, and I've heard people say, David, I'm sorry, I'm interrupting you. I do that. I do that because I forget things if I don't spit them out. That some people said Paul's last comment about the higher rates, that it's okay and it means that, you know, we're having a recovery, it's a normal thing, is a policy error. Because you know, they think that he should be talking about that we're not going to let this happen, and we're going to do everything we can to, you know, not let rates go higher. Not that it's okay, because if it's okay, maybe the bond vigilantes will continue to press their case. Do you think he's going to backtrack today?
We'll have to see. We'll see what comes out of it. I mean, I think the general sense we've gotten from the Fed is we'll do whatever it takes to keep stock prices up, and I think that's going to be the most important metric that they're probably going to end up taking action on. And you know, we'll see what happens if and this is the big question, right? If stocks really do sell off from here, and you know, Amazon is breaking down through its 200-day and breaking down to a new swing low. I mean, half of the FANG stocks are breaking down. You know, a lot of names that have been doing very well, and you know, and also I would say the whole ARK Innovation Fund, you know, these sorts of funds that have ballooned up, that have gone into a lot of names. If they get a lot of redemptions, they have to be selling a lot of stocks that have gone up really well. And while the market can hold up and while stocks like American Express can go up while those other stocks are going down, at some point, people feel a panic and they start selling everything. They don't just start selling Peloton. They sell everything in their portfolio just to get out and preserve capital. That's when everything starts to get dragged down with it. And then we'll see what comments you get from the Fed to try to, you know, prevent that from getting really painful.
Yeah. What's the expression? You could own the best stock in a bad market and it doesn't matter. Huh?
It's true. It's true. And so I think that, you know, interest rates being where they are is still not a bad thing. That's actually a sign of a good thing. And I think you can see from a lot of financial stocks why that's okay. You can see oil stocks going up because of oil prices going up. But when interest rates get to a certain point, when the yield curve accelerates too much, it starts to not be a good thing. And that's when consumers start to feel the pain, and it's harder to borrow money, and you know, it's harder for companies to borrow money. And that's when things start to get a little more negative. And that's when the negative effect of higher interest rates will happen. That's still a little ways off, I would say. But I'm more concerned about the flows issue of it. You know, there are a lot of new entrants to the market, and they're not probably embracing this whole rotation thing. They're probably seeing names that they've bought that start going down a lot, and there will be a panic. And that's when people just start selling stuff just to get out of it and preserve cash. And
what a great time to be putting together a shopping list for, you know, say we get a 10-15% sell-off in the market. I know I'd be, you know, I'd be looking at commodity related stocks if that happened. I'd be looking at cannabis stocks if that happened. You know, I think that if we get this sell-off, that we'll be able to buy the world. You know, something else that's shifting, I know you follow it through UUP, is the weak dollar has also been part of the bullish scenario in equities for, you know, at least the last year or so. Dollar weakness. Well, since COVID, Dixie was 103, and now we're just, you know, trading under 91. What's your look here on the U.S. dollar? Does it you're over your 50, so it's accomplished one thing here. Is that looking pretty good to you, David, for some type of bear market rally, maybe back to 93 to 95?
So I think that makes a ton of sense. What worries me about that thesis you just lined up is it looks a lot to me like August and September of last year, where you put in a new low at the end of September or the end of August. You rallied, you broke above the trend line, you pulled up a little bit. And that right there felt like, all right, the dollar's going to go back up to 97. We're going to.
I thought so then too.
And it made a ton of technical sense as well. And then it just stopped. And so if you look at that period versus this period, there are a lot of similarities there. And we're right at this point where we've made a higher low, which draws me in certainly. And then we start breaking higher. So is there a potential of us? And I would 94.80, which would be back to the September, 94, 94.50. That would be sort of the October to September peaks back there. That's a Fibonacci retracement level. If you take the whole downtrend, you take 38% of the way, that's just below 95. So I think that would be that would be quite a strong counter trend move that would shake a lot of people out. You could see a market distribution, you could see a dollar rally, and that would be sort of the bear market case in the short term. That, I mean, the S&P goes down to 3,200. That would be a meaningful drop in stocks. And I think, to your point, it's, you know, how are you going to react to that? In my time at Fidelity, the discussion was that was the best thing to happen. That's great companies at a bargain. And all of a sudden it looks like good stocks that you may have missed out on coming back to more reasonable levels. You don't have to worry about ridiculous valuations. You're buying it at decent levels again. And if you're bullish for the long term, which I am, I would argue the best thing to happen would be a nice, meaningful correction to sort of unwind a lot of the euphoria that we've seen.
Yeah, Garrett, some of these Reddit traders will really be looking for their $1,400 stimulus check to have ammunition. To have ammunition again. You know, I wanted to bring up the fact that before COVID, 10-year yields were 2%. So we're not even back to there. And you talked about it's mainly the velocity of the steepening of the curve. Do you have any kind of above 2%? I'm actually looking for a pullback in yields. I think we've completed this first wave. I could be wrong, that we might pull back to, you know, 1% again. And I think what might be behind it would be a stock market sell-off. So I'm wondering if you think there's any level, and maybe we've reached it here, that would really put a damper on growth in the market. Because, you know, you can have disintermediation for a long time. You and I go back to 87, and remember, the bond markets were in a huge bear market. The dollar was in a huge bear market while the stock market kept going up. For, you know, disintermediation lasted months and months until it finally reached a tipping point. What do you think that would be, above 2% on the 10-year?
Yeah, and I think the scenario you just described makes a ton of sense. I mean, I tend to look at Fibonacci retracements on a long-term perspective, just to give you a sense of how far we've retraced some of these long-term moves. And if you take the November 2018 high, the March 2020 low in the 10-year yield, we're about 38.2%, almost exactly retracing that back up there. That lines up from the low sort of late fall of 2019. This should be a very reasonable place for there to be a break of sorts. The other thing I would look at is the TLT, or the AG, or one of the bond ETFs. Yeah. And what's happened there is you're nearing the low from fall of 2019. You're really in a rounding error away from that. We took out the COVID crash low, and now we're trading above it. I mean, I was thinking that was a stop hunt. I think they're a buy here for a rally, maybe back to 150. So I think when you're looking at bonds, I think you could totally make the argument for that. I think when you're looking at gold and gold stocks, you're seeing. You know, you're a mind reader. You know, I've been pretty negative gold for a while, David, but we're reaching like 50% retracement levels. And if you look at the sentiment indicators, there's only like 20% bulls. I was thinking this might be a decent area, not to maybe marry it. I don't know if we're going to new highs, but maybe for at least a trade. And what a lot of people might get wrong is they go, well, the dollar is going to rally, so why would I want to buy gold? But all you have to do is bring up what's happened in the last, say, month or so. The dollar's been weakening and gold's been going down. Yeah. Right? Which you don't normally see. No, and a lot of people, I would, as always, it's super helpful for us. We think it's helpful to simplify the relationship between gold and the dollar. Well, how could gold go up if the dollar's going up? And just as you said, I can show you plenty of examples where they move apart. I can show you plenty of examples where they move together. You know, over longer term periods, that relationship tends to be the case. But there are months and months where those relationships are not one and one. You know, they'll change just because of the condition. Because it's not a relationship in a vacuum. There are a lot of other moving parts to deal with. With gold and with bonds, as a trend follower, I'm less excited about buying weakness like this, but if there's a time when I feel like a contrarian, it's now, when you've seen stocks that have had such a run and are showing clear topping signals. You have gold and bonds oversold and reaching key support levels. It certainly seems like a reasonable time, and the dollar starting to revert back higher a little bit. You can see that scenario where something like gold, where things like bonds actually have a nice little stretch during the market correction and equity correction. It lines up very, very well.
Okay, and actually the silver shares, there's an ETF SLIJ. You'll see it probably has a stronger chart pattern than that was GLD, but I'm talking about yeah, you could pull up silver, but it's I'm looking at SILJ. Okay, there it is. See how much better it's holding up. I mean, we're probably at a 23% retrace on this. Not
Yeah.
even see. So silver is still holding up better.
Way better.
Still, yeah, still think it could maybe go to 23, but it's
Yep.
holding up way better. And I think that's also another target. The Reddit, all those GameStop people came in and they were going to squeeze the shorts in silver, but no one was short. Retail was long. All right,
we missed the crucial piece of that puzzle.
Well, yeah, don't you think, David, there's a big difference between an individual issue and a global commodity market that I'm even surprised that a social network could have that much power in the market to do what they've done. I don't know about you, but I was always taught to fade retail.
No, it's right. And I mean, when you look at these names and sort of how things played out, I mean, we can't doubt it anymore that a group of committed individual investors can have real impact on the market. We're seeing that. We're seeing the impacts of a group of individual investors grouping together and hitting one side of it. And what's interesting is the exact scenario that played out is sort of different, right? The way that it actually happened, the way social media was used, the way it played out with shorts was all different. But short squeezes have been around for quite a while, as you know, right? That's a well-known issue. The whole bubble
as they have pumped and dumps.
Exactly right, and the names have been different, and the structure's been different, but the bubble scenario, the idea that something shoots up, and the initial idea is driven by a short squeeze, but eventually it's a bubble where you draw people in to chase it. And eventually the people that got in early are the ones that can sell. And the last people in are the ones left holding the bag at the top. And that's what you saw with a lot of these names with GameStop, with AMC, and they've all had their secondary bounce now in the last week or two. But these don't end well. The left side of the bubbles are very good. The right sides tend to disrupt very quickly.
Okay, David, anything else that you may want to share with us today that was on your mind and I took you off track?
No problem. I think, the other things I would say is, names that I think are important to watch here as you're tracking this equity unwind or potential equity unwind. There's a couple sort of buckets that I would look at. The S&P itself and seeing if it's able to hold its January low 3,700. I think that's key. I think when that breaks, you start to see people get a lot more cautious. And I think that's when you can get a cascade of markets going lower because people go more into risk off mode, especially institutions will see that as a negative sign. The whole work from home trade, I don't want to say it's broken, but it certainly feels broken in the short term, and Peloton might be a perfect example of this. This is a stock that made a new all-time high yet again in October, in December, even in January, made a new 52-week high, new all-time high, and now has retraced from 170 down almost to 100, which is a big round number. So something like Peloton holding its 200-day, holding 100, that's sort of like the last level, right? Is it able to still be a legitimate stock that has upside, or was that just a thing that happened and now we need to totally reset? So I think that's one to watch there. And then, the last thing with Amazon, I think, the FANG trade, we can argue that, the market
dead since last August.
I was going to say, if you look, the Amazon topped in September. It topped at the beginning of September. Everything after the September market peak has not been with the FANG stocks really at all. Now, things like Google have done okay, but as a group, that was it. And that they got us to that point. From there, Amazon's been sideways, and now it's breaking down through this range that's been in for the last 6 months. The relative strength, looking at Amazon versus the S&P, it's been just down consistently. So this is not a new issue that, stocks like Amazon have underperformed. And my point is, in the short term, can the market rally without all of these big mega cap names? Of course, and that's what we've seen. We've seen stocks do okay. We've seen financials and energy, take up the slack and drive to new highs. But at some point, big mega cap benchmark names like this breaking down really start to have ripple effects. And it's where they're, people take risk off, and all of a sudden there are a lot of redemptions in funds that own a lot of Amazon, and they have to sell a lot of their Amazon position.
Could go to 2,500, just looking at the width or breadth of that formation from, around 3,500 to 29, breaking down here, 500. Yeah.
So
prior
I mean,
highs. Yeah.
Yeah, it's not unreasonable that you see a much
Halfway back.
And the same, I feel like it's the same thing with interest rates, right? Interest rates going up to a ways is a good thing. After a while, it starts to represent something more. And I think that's what you're seeing with stocks like Amazon. They've pulled back, they've struggled, but if they really start to break some key support levels and continue to rotate lower, I think that starts to drag everything down a little bit. But we should caution. I mean, all of these things that I mentioned, I think in some ways, the most obvious chart to look at, and I'll maybe leave you with this, is the semiconductor chart.
Yeah.
If you look at the SMH, this chart of higher prices and lower momentum, this will be in future textbooks on technical analysis for one of two reasons. Either number one, it is the world's most perfect example of a bearish divergence that works out perfectly. And we break down, the SMH gets below 225, which would take it below its 50-day and below its January low. It is a rotation from bullish to bearish. And that's what I think is going to happen here. But option B is this bearish divergence does not work. Semiconductors recover and break to new highs. And all of a sudden it looks kind of like Tesla did, where you have all these false positives on the way up, and it really just continues to fuel this euphoric rise in stock. So that latter option could happen, but I think it's going to be more former. I'm seeing a lot of divergences in a lot of groups like this that feel like they're ready to go into distribution mode. And again, I think if you're long-term bullish, which I am, I think arguably that's the best thing to happen. We've had too much of a euphoric rise. You need backing and filling to sort of reset. And I think that's what we're looking at here in the next month for sure.
Okay, David, if you'd like to show your website, this would be a good time. And you could follow David at dkellercmt on Twitter, and catch him on stockcharts.com. And David also has his own website that you could go to. And as you can tell, David gives very clean looks and doesn't really hedge his opinions, and has a method to his madness. So Zero Alpha Research. Okay.
Yeah, marketmisbehavior.com is my website. My YouTube channel has the same name. And I always think of it, my goal is to help investors make better decisions. That's what I'm trying to do. And it's part of that is having a good technical toolkit, having a good set of charts to allow you to do it. The other part is, getting inside your own head, having a good conversation with yourself. And we work on a little of both.
Yeah, I found myself this weekend saying, "Be patient, Dale. Be patient, Dale." So we have to do the self-talk. So Brock is saying great interview. Others are saying great analysis, and your mission is accomplished, David, for what you're trying to do. You did it here today in FACE. Thank you, my trading warrior brother, for being here, and we'll see you again this summer. Appreciate your time today.
Take care, my friend.
All right, that's a wrap, everyone. Remember, don't just count your pips, count your blessings. Could join the guys for Morning Edge in about 20 minutes. Adios. You're welcome. You're welcome. See you tomorrow for the NFP.